I want to talk a little bit about year-end tax planning today. This is a great time of year to consider some year-end tax moves to help save a little bit of your tax liability. We're having these conversations with clients in earnest over these last couple weeks and will for the next couple weeks. And I just wanted to talk to you about a few of the items that we've talked with clients just over this last week, just in case this might help you and save a little bit of your hard-earned money. Well, one of the items that we're thinking about this time of year is often about taking advantage of inefficiencies in a tax situation from year to year. And when I mean inefficiencies, a lot of this is focused around smoothing clients' tax rates year over year. So, one thing that we don't like to do is have a client in the top tax bracket in a 37% bracket, and then in the next year have them in a 24% tax bracket. There's a lot of brackets in between there, and if we can, we'd love to smooth some of that income from the 37% high income year down to the 24% lower income year. So a lot of our work is spent trying to push income from one year to the other, or push expenses between years to make most effective use of those. So one of the ways that you can do that, especially if you have some equity compensation, a couple of ideas here. One is if you have non-qualified stock options, you can control when those are exercised. Presumably, if those shares have already vested or if those options have already vested, then you can control when to exercise those NQSOs, and whichever year you decide to exercise those, and that's where the income is going to come into play. So one of the things to think about is, if you're in a relatively low income year, does it make sense to exercise some of those NQSOs to push income into this year if you think a future year is going to be higher? Another thing along the lines of stock options and tax planning is if you have incentive stock options. And here, it's a little bit of a different concept, but we're dealing with the alternative minimum tax in this case. And one of the things that's available to us is there is a certain amount of income we can have for AMT tax purposes that isn't subject to AMT. There's an exemption amount that we can take advantage of. And for each client, this amount can be a little bit different, just depending on the mix of your income and how much income you've had during the year. But for everyone, there's a certain level of incentive stock options that you can exercise without being subject to AMT. So provided that that's a good investment for you, it may make sense for you to take a look at that and see if you want to exercise some ISOs before the end of the year to use up that exemption amount. Another couple items that we're talking to clients about this time of year is also Roth conversions. This is another idea that can make a lot of sense if you're in a low income year. So real quickly, Roth conversion is pushing forward income in a pre-tax IRA account and pushing it into the current year where hopefully income is a little bit lower. That's why we'd want to push it into this year versus later on where we expect that your income rates would be a little bit higher. So this is a way to get some money in a Roth bucket, which can be a little bit more advantageous sometimes than having pre-tax money in a retirement account. It's a little bit more flexible. There is ways, subject to some 5-year rules, that you can pull out some of those contributions. So we do like to have clients with money in a couple different buckets, both taxable savings accounts, which of course are fully taxable. Interest and dividends are taxable to you each year. Roth bucket, like what we talked about, because some of that money can come out of there even before retirement years. And then the pre-tax retirement accounts, like rollover IRAs that are pre-tax money, or your 401k that's pre-tax money. Having money in all of those buckets can be advantageous, especially if you're looking to early retire at some point. One other planning item that I'll leave you with today is considering the impact of charitable contributions on your tax situation. A lot of our clients are able to itemize. A lot of this comes down to if you have a mortgage, generally with interest rates being what they are. If you have a mortgage, your interest expense will often let you be able to itemize your deductions. If you can itemize, that means any charitable contributions that you give have some level of tax benefit to you. Now, you're not going to make money giving to charity. Uh, any benefit that you receive is going to be a fraction of the dollar that you spend. But that can be anywhere from as low as 10% all the way up to 37%. So, those dollars that you're giving to charity, make sure you're keeping receipts for those because they can help out your tax situation. Now, as we think about this from a tax planning perspective, so what's the play here, John? So if you have a situation where you might be itemizing in one year but not in another, this is also another opportunity to bunch charitable contributions into the year that you're going to itemize so you get more benefit for them. And as you're paying down your mortgage, for instance, you may find that in the future you wouldn't be able to itemize normally. If that's the case, you could consider doing a 1 year on, kind of 1 year off contribution schedule where you would maybe give 2 years of charitable contributions in one tax year. For instance, you could give in January and December. You would receive all of the itemized deduction benefit for that in the same calendar year. And from a charity perspective, you've given those donations about 12 months apart, well, 11 months apart or so. And that way you're getting a little bit more tax bang for your buck. A more advanced version of this is considering a donor advised fund. A donor advised fund would allow you to give multiple years of charitable contributions to the donor advised fund, take the deduction all in that same calendar year. But with the donor advised fund, you could parcel out that money over a longer period of time to the eligible charities. So you could give them put 5 years worth of money into the donor advised fund and give that money over a 5 year period to the charities as you want to. The important thing to keep in mind with that is it's a completed donation. That's why you get the deduction. So even though that money is somewhat controlled by you in the donor advised fund, you can't take it back out. It's locked in there. So you do have to give it to charity at that point. And another side benefit of a donor advised fund is it can often accept any stock that you might have. So if you have stock that has appreciated in value over time, a great way from a tax perspective, if you're going to give money to charity anyway, giving the stock either directly to the charity, which can be a little bit more difficult, or giving the stock to the donor advised fund, which is a little bit easier. You can avoid getting taxed on the capital gain, but also get a full donation value for that stock gift. Important caveat, you do need to give long-term capital gain stocks. That means you have to have held the stock for more than 1 year. So hope these couple ideas spark some thought for you. Certainly not too late to do some tax planning at this point. So if you haven't taken a look at your taxes, make sure you set some time here during the holidays or before to take a look at that and see if there's any opportunities for you to save some tax money going forward.